still sitting on the fence because they think rates are too high and they just don't think they can afford to buy right now. So hopefully this might give you and them the opportunity to change their mind and see what the opportunity is in this market. So I'm going to go ahead and I'm going to share my screen and we can go ahead and get started. So to start out, I'm going to make a case for homeownership. The senior economist for Zillow started out by saying the American dream is still owning a home. There's a lot of pent-up demand for ownership. That isn't going to go away. Now, Jessica Lautz, the deputy chief and vice president for NAR, has said homeownership is still the #1 way to build wealth in America. But I like this one with Habitat for Humanity, which says overall homeownership promotes wealth building by acting as a forced savings mechanism and through home value appreciation. Homeowners make monthly payments that increase their equity in their homes by paying down the principal balance of their mortgage. In addition to owning a home, it promotes intergenerational homeownership and wealth building. Children of homeowners transition into homeownership earlier, which lengthening the period over which they can accumulate wealth. So homeownership is still a valuable piece of our community. As you can see, homeowners' net worth is almost 40 times greater than that of renters. So if you can see here, the source of this is from the Fed, which says that homeowner households net worth is $396,200 versus that of renters, which is only $10,400. It's quite a difference. So we're going to talk about 5 different topics today. We're going to talk about the non-occupant co-borrower. We're going to talk about the Portfolio 100 loan or the Powerhouse 100 loan, which is a portfolio product. We're going to talk about the accessory dwelling unit or ADUs. The fourth one we're going to speak about is the community portfolio loan. And then, of course, we're going to finish it up with the all-time favorite of the VA or Veterans Administration loan. So to start out with the non-occupant co-borrower loan, when I started in this business over 30 years ago, we used to know this as the FHA kitty condo. But what you don't know is that you didn't have to use this just with FHA and you didn't have to use it just to buy a condo. It wasn't necessarily really needed to be used as a condo. It just so happened that condos were the way to buy affordable housing back in the day. So the non-occupant co-borrower is just what it says. The co-signer or co-applicant does not occupy the property. The primary borrower is the one who occupies the property, and then they have a co-signer or a non-occupant co-borrower. So that becomes really the co-guarantor. So some property or some product specifics of this program is you can actually use the non-occupant co-borrower for many of the different programs. You can use it for FHA, you can use it for conventional. It's a little bit confusing on VA. I'm going to say that you can't use it for VA, but in reality, you can. It's just a really different type of product than most VA loans, and it's known as a joint loan. So I'm going to kind of asterisk that, and we'll talk about that a little bit later. It's allowed on jumbo products. Some jumbo investors allow it, some jumbo products do not. You'd have to speak to the specific jumbo product. And it's also allowed on some portfolio products. Not all, but some portfolio products do allow for a non-occupant or co-signing borrower. Now, FHA requires 3.5% down payment. Conventional will require a 5% down payment. They will not, Fannie and Freddie will not allow for 3% down payment on the conventional product. Now, the VA, again, because it's not really allowed, the reason why it's not considered a program is because the veteran can only use their eligibility with a spouse. And so the joint loan will only allow the veteran to use their eligibility for themselves. So it becomes, they cannot do 100% financing when you do a joint loan. The jumbo product can go anywhere from 5, 10 to 20% down, depending upon the product and when you're using a non-occupying co-borrower. And then again, with a portfolio product, it totally depends upon the portfolio loan. Now, under the debt ratios, a debt ratio is going to be the debt to income ratio. So with both FHA and conventional, as long as we have an AUS approval on the conventional loan, we put all of the income together, and then we put all of the debts together, and we combine them to come up with the debt to income ratio. So the occupant may not have any income, and as long as the non-occupant can qualify for that full amount, we consider that a combined or blended ratio. So we don't actually need the occupant to have their own occupant ratio. We actually consider that blended, put it all into a pot, and we as long as they can qualify, that's great. Now, if we are doing a manually underwritten loan, on a conventional loan, there are specific ratios that the occupant borrower has to have. The same with the jumbo and the same with the portfolio loan. Typically, there's a ratio that the occupant has to comply with. Now, on credit scores, FHA will allow you to go down to 580, but remember that there's probably going to be a pricing difference anywhere from 580 to a 620 credit score. Conventional loans are going to be credit-based, but it will go down to a 620. As long as all borrowers have a 620 credit score, that seems to work. And then the jumbo and portfolio products, again, are going to be based upon the specific product from those investors. Now, might not seem too exciting, might really be the most exciting product that we're going to talk about until you start thinking about what their uses could be. Now, the original purpose of an FHA kiddie condo actually had to do with student housing or campus housing. So when you have somebody that's going off to college, like I did, you start looking at the price of housing for your student. Now, when my daughter went into off-campus housing down at U of A, she and three other girlfriends went into a 4-bedroom apartment with 2 bathrooms, a common kitchen, and a common living space. So just an apartment, nothing big, nothing that was extravagant. They had 1 bedroom apiece, and each one of them in a not very nice apartment. I mean, it wasn't anything to write home about. Each one of them paid $1,000 a piece to have a bedroom within this apartment building. That's a $4,000 a month rent payment. So if you think about that, paying that for 4 years, in my daughter's case, 5 years, but if you think about the cost of housing for students right now, that is a significant issue with the cost of college, or the cost of schooling for kids. So what the kiddie condo came around to do was to help parents help their children afford to have housing at universities or colleges. So the child who was in school could qualify for the occupancy portion of that loan, and then the parent could actually co-sign or income qualify for the actual loan. But what that allowed them to do is it allowed the parent to be able to put down, in FHA's case, as little as 3.5% down of their child, occupy the property, invite roommates and have roommates live there, help pay the majority of the mortgage, and 4 years later, you either had a boatload of equity or you had the ability to keep that as a rental property as the child moves on and does whatever they're going to do in their life. So it's a great way to accommodate for campus housing. It's a great way to start investing in a part of their life where it gets them started even before they know they're ready to get started into investing in real estate. So it does, the great thing about it is their kids don't even need to be in school, but if they are in school, it's also becomes a great area for future investment properties if you decide to hold on to that property. So the co-signer can completely income qualify for the property. The occupant just needs to make sure that they have the credit quality that they need to be able to qualify, and then they satisfy the occupancy requirement. Roommates then help pay for the mortgage. The equity grows while they're in school, and then either the occupant or the non-occupant can keep it as a rental, or you can sell it for the next home. Or the co-signer can use as an inexpensive way to create investment properties for the future. It's a great option. It's a fantastic option. And very few people know that you can actually use the FHA non-occupant co-borrower or kitty condo multiple times with multiple children. So obviously, if they're going to the same school, it might be a little bit more difficult. But if they're going to different schools, you actually can do this with multiple children. And because we lend in about 48 different states, we can help you across the country. So another different option would be assisting an elderly parent. This is a different type of non-occupant co-borrower where you may have the opportunity to assist maybe your recently widowed or widow or parent who maybe is not ready to go into an assisted living facility, or maybe doesn't want to come and live with you and your family. They may just want to, they may want to still live on their own, but maybe live closer into within your community. They may not be ready to, they just may not be ready to or financially able to live on their own, and you may be willing to help them a little bit on their way. But this is also a great way for you to co-sign with them to make them still feel like they are financially or still on their own. So they might not have a lot of individual credit because they might not be the one that continued or really held the financial household together. And so you as the co-signer may be the one that keeps that or helps that picture look a little stronger. But you again can keep it as a rental or possibly have that equity growth to help pay for future assisted living once that might be the case in the future. Again, a co-signer can use this as a future inexpensive way to create an investment property as well. Now, the last one is becoming more of a timely use of the co-signing loan, which is the joint investment property. This is actually a great way to talk to your clients, especially if you have clients that have children that are starting out in life, either through marriage or getting out of school or starting their careers, and they can't seem to afford the properties on their own, but they want that opportunity to start investing, and they feel like they possibly have the ability to invest with them and have that relationship that they feel comfortable to do so. This is where a family member can be the co-signer, and again, the person who's occupying the property can get roommates to help to help pay for the mortgage. Maybe they're not at that spot in their life where they've got a spouse or a family, but they are in a place where they're starting out in their job and they have roommates that can help pay for the rent rather than going and continuing to rent and throw their money away. So they can create a legal investment agreement with designated terms, and it also helps increase the investment portfolio for both the occupant and the non-occupant co-borrower. So this is an opportunity for people to help their family get into properties in a very methodical investment way where their occupant is fulfilling a need for housing and the co-signer is fulfilling the need to help that occupant get into the housing market. So some tips along the way through all of the years of experience. Number one, start with the end in mind. What is the exit strategy for both parties? Make sure you are communicating this. Make sure that the parties involved understand they need to have a conversation about the end. What is the end goal of both parties? What are the scenarios where the end goal may change? What if there's a divorce on one side, or what if there's a marriage on the other side? What if the um, occupant gets relocated and they have to move? Then what? What are the steps that are going to occur if the end goal changes? Just have the conversation up front, and then there aren't going to be as many issues down the road. Define expectations. Who is responsible for making the payments on time? Who's going to be notified? Who is going to make sure that payments are made so credit is not affected? Who is responsible for the tax benefits and or consequences? What happens if there are gains, or what happens if there are losses? So if those discussions are made up front, then there's no questions if it occurs down the road. And always, always, always make this a legal document. Put it in writing. Even if you have to hire an inexpensive legal document writer or an attorney, it's always better to put it in writing so there's no questions asked and the expectations are set. So remember, family and money are oftentimes mixed and often have poor outcomes. So the best way to solve that is to have those questions taken care of up front. But again, a great opportunity to get people into houses and to get our next generation able to purchase homes. So our second option is the Powerhouse 100 product. Most people do not know about this product because it is a portfolio product through our bank. We are backed by a bank who has a product that is a portfolio loan that makes it easier than ever for home buyers to achieve their home ownership goals. Those home ownership goals are made a lot easier when you don't have to have a down payment involved when purchasing a property. So some of the product specifics on this product is there is no down payment necessary. One of the biggest obstacles of purchasing a home is the down payment. The max debt to income ratio on this, because it is manually underwritten, it's not done through an automated system. The max debt to income ratio is 41%. The minimum credit score is someone that has a 720 credit score or higher. But you can borrow up to $766,550 or the max conforming loan limit. So this product does allow for a borrower to go up to the max conforming loan limit and still not have to put any money down. The great thing about that is that most down payment assistance products, most zero down products, have to have some sort of first-time homebuyer requirement and or income limitations, which is why most first-time homebuyer products do not work, because the property price typically exceeds the median household income limitations that are set to be able to use those products. Well, this product, because it's put together by the bank, the whole purpose is to help people get into homes. And we know that in order to do that, we have to make some concessions in order to make that work. So this product does not require income limitations. So there are no income limitations allowing the borrower to borrow up to that $766,000. You do not have to be a first-time home buyer. However, you cannot retain your current residence. So if you do have a home right now, you will have to sell that at the time of closing of the new home. So the borrower must contribute 1% of their own funds to the transaction. That doesn't mean in a down payment, but that 1% can come from a gift from a family member. So just like with FHA, you can get the gift for all of the down payment. You can get the gift for your closing costs. And that gift can come from in the form of a gift from family, mom, dad, cousin, aunts, uncles, whatever. But it's that gift is only 1% of the total purchase price of the home. So even if you're buying a property of 766,000, the max amount that you're going to need to contribute to this property is $7,600. So, and the greatest thing about this is that that 1% can also be covering 2 months worth of reserves. So you might not even have to contribute it to the property. It may just even be required in the reserves. So all of that could come from a gift, closing cost prepaids, or 2 months reserves, 100% financing. Even the gift can even cover the reserves if possible. The seller can contribute up to 3% towards sales concessions. And on this particular product, non-occupant co-borrowers, like we just talked about, are not allowed on this program. Now, how does this work? How does it look like in contrast to what other products are out there? So if we were to use somebody that is paying about $3,000 a month in rent, so if you take a look at someone that's paying $3,000 a month in rent, they can qualify for and they want to keep their payments very similar, they're going to qualify for about $400,000 in a purchase price for a home. However, that person most likely is going to exceed the income limitations that allow for participation in most of the first-time homebuyer programs that give them benefits for the lower interest rates and lower mortgage insurance coverages. So they're going to be on a standard 3% down Fannie Freddie product. They're going to have to come in with a minimum of 3% down on that $400,000 purchase price, which is going to be $12,000. So the interest rates in the last couple of weeks have been about 7.375 on that product, putting very little towards buying down the interest rate. So their loan amount is going to be about $388,000. Their total payment, including an estimate for property taxes, homeowners insurance, and mortgage insurance, would be about $3,213 per month. So fairly close to that rent payment of $3,000 per month. Now on the Powerhouse 100 5-year fixed rate ARM, which means it's fixed for 5 years and then turns into a 6-month adjustable rate, we would do a 100% loan to value loan. So you'd be borrowing $400,000. The interest rate is slightly higher at 7.5%. And your monthly payment would be about $3,300 a month. Again, total property taxes, homeowners insurance, and mortgage insurance. But you would not have to put any money down, and you'd be coming in with you'd need to come in with at least 1% and your closing costs on this particular one to compare apples to apples. Now, if in the next two columns, we're going to assume that you could maybe negotiate to have the seller pay some closing costs. The way we do that is we increase if we increase the purchase price by the amount so that the buyer has to come in with the minimum amount that they're required to come in with. In the first option, the purchase price would be about $408,600. They'd be coming in with $12,258. Interest rate stays the same. And your total payment is $3,282 per month. And then on the Powerhouse 100, we bump up the price to $411,000. That $11,000 would cover the closing costs and setting up the escrow accounts. And your payment would increase about $84 a month to $33.86. Now, what does that look like in terms of cash to close? So again, the 3% down product, if they were to pay for their own closing costs and 3% down, they're going to come to closing with $20,500. On the Powerhouse 100, they would need to come in with about $11,000 if they were going to pay their own closing costs. But if we have the sellers covering all the closing costs, and if they were doing the 3% down program, you would actually, the seller or the buyer has to come in with at least $12,000. So they'd be coming in with that $12,000. And in the last column, if we only had the buyer coming in with about $161 because they don't need to put any money down, they'd need about $67.72 a month in reserves, which can come from a gift. And the seller would pay all the closing costs, and the buyer and the monthly payment, like I said, would go up about $84 per month from the option where they were paying their own closing costs. Now, there are some other pieces of information in here just to kind of go through to show you. There are some tax benefits for renting just because of the standard deduction. So if you want to talk to a client about the fact that, yeah, I'm only paying $3,000 a month in rent, but you're telling me I have to jump up my payment. So if I'm looking over here to $3,386 a month, that's $386 more than what I would be paying in rent. Well, let's break that down a little bit. On rent, you're getting a $259 a month standard deduction. So my actual net rent payment is going to be $2,741 per month. But when I buy a home and my payment is $3,386, let's talk about what that really is. My tax benefit because the interest rates are slightly higher, I'm going to increase my tax benefit if I'm at a 24% tax bracket. My tax benefit goes up to $707 per month rather than that $259. So I actually have an increase in tax benefit, a substantial increase in tax benefit, plus I am paying $305 a month towards principal. That's kind of like a forced savings account because I am paying down towards the equity in that house because it's something that I own. It's like buying an investment. I am buying $300 and $305 a month towards owning that property free and clear. So I am looking at $305 forced savings every single month. So my net, if I take a look at the increased tax benefit of $700 a month, plus my $305 forced savings account, my net payment of that $33.86 is truly $2,373 per month versus my net in rent of $2,741. So in reality, am I paying more in my mortgage payment or am I paying more in rent when it comes to being financially aware? So not only are we looking at that being able to come to closing with $161 a month, not only have I shown the client that my rent payment, my net rent payment is actually more than a net mortgage payment, but let's take a look at this. If we look at renting versus owning after just 3 years, I have paid, if I continue to pay rent and have a 3.5% annual rent increase every year for the next 3 years versus having a pretty conservative 5% annual appreciation in my house payment or my house, that I bought at $400,000, and I use a standard $12,950 standard deduction on rent versus the deduction I can take at a 24% tax bracket, let's see how this stacks up. I'm going to pay in rent $101,000 or $111,824. I'm going to get a tax benefit of about $9,324 over 3 years. So my net cost is going to be $102,500 in 3 years. But if we look at that Powerhouse 100 with only putting in $106 at closing, I get a gift for $6,700 for 2 months worth of reserves. The sellers pay my closing costs. Then and I pay $411 or $411,000 for that property. I will have paid $12,271 over 3 years in principal. I will have received $23,000 in tax benefit, which puts my net cost of to $86,540. Now, at this point, with a 5% appreciation, my property is now worth $475,784. My loan balance is $398,729. And I now have 3 years later, with basically no money invested, a savings account of net equity of $77,055. If I'm a first-time home buyer, that is a pretty good investment. So I've taken $101 in cash at closing and increased my net worth by $77,000. So option number 3, the accessory dwelling unit or ADU. Now, homeownership doesn't always take a traditional route. So what is an ADU? An ADU is a 1, 2, or 3 unit property that has an additional finished area that includes a kitchen, a bathroom, a separate area or separate entrance. It's independent of the primary dwelling unit. It's smaller in size than the primary dwelling, and it contributes less value of the property than the primary dwelling unit. And it's zoned legal or legal non-conforming in the property restrictions. Now, examples of an ADU are an ADU that's above a detached garage, so an apartment above a detached garage, an attached or a detached casita ADU that complies with all of the things above, or maybe a mother-in-law apartment that's an attached or an ADU that matches all of those criteria. Now, what an ADU is not, it's not a 2 or 3 unit property with an ADU that does not comply with the property zoning and land use requirements. It is not a 1, 2, or 3 unit property with 2 or more ADUs. And it's not a 4 unit property with an ADU. It's only a 1, 2, or 3 unit property. An ADU property is not also a property that does not have at least one comparable sale that demonstrates the property's conformity to the local market area. It has to have some sort of a comparable sale, whether it's even outside of it might be in a competing market, neighborhood, even if it's a little bit further away from the current neighborhood, or even if it's a little bit of an older sale. It just needs to show that it does demonstrate the property's conformity to the area. It's also not a manufactured home that also has a manufactured ADU. Now, you can have a traditional home with a manufactured ADU, and that would be okay, but it can't be both manufactured. That manufactured ADU also has to be at least 400 feet. So it can't be something that's smaller than 400 square feet if it's a manufactured ADU. And a manufactured ADU is not one that is legally not classified as real property. So the ADU that's manufactured has to be permanently attached to the permanent foundation. So why is this important? I mean, this wouldn't be a big deal if because I mean ADUs have been around for a long time. Casitas have been around. This doesn't seem like it's a big deal. However, in September of 2022, Freddie Mac, because Fannie Mae has completely different rules, but Freddie Mac made a change saying we want to help the first-time home buying community or the home buying community to help um, these non-traditional type family living spaces to be more recognizable to what our communities actually look like. Because up until then, a single family home, even though it had an accessory dwelling unit, could not be used as income to qualify for a mortgage, even though you bought it specifically to be able to rent it out. So what Freddie Mac said in September of 22 is, you know what? If if the ADU complies with these specific product requirements and the loan complied with the specific product requirements, we will buy it. So the product specifications are that if you're a first-time home buyer, you have to put 3% down. If you're not a first-time home buyer, you have to put 5% down. The max loan can go up to the 766, 550, which is the conforming loan limit. You have to have a minimum credit score of 620, and the automated underwriting system will determine the max debt to income ratio. Typically, it's not going to be more than 50%. So what that does is that allows you to use the income on that ADU unit. So if you rent it out, that lease that would be put on that ADU unit, you can use 75% of that lease to help qualify you for the loan for the property itself. Almost like a 2 or 3 unit property that we've always been able to do, but it's on a single family this time with just an accessory dwelling. So if the ADU has a current lease, we'd have to use that lease as long as we can justify or document with an appraisal analysis that says that is an acceptable, that would be the market rents and it does justify that amount. We would use 75% of that as qualifying income. As long as it is not more than 30% of the total monthly income of the borrower that we're qualifying. So again, a great way to help a borrower qualify for more and actually find a property that helps this community to more represent more of what, like how the community actually lives. So what does that look like? Again, if we have somebody that's paying rent of $2,750 per month, they've got 5% down, buying a $400,000 purchase price because that's what they can qualify for. That total monthly payment is about $3,160 per month. But if we can use 75% of, let's say, a $600 a month additional income because of an accessory dwelling, I can bump that up to qualify for an additional $50,000 in a property that could very well increase the ability to find a property at $450,000, which does increase their monthly payment to $3,500, but that might just give us another bedroom. That might give the borrower the ability to have another roommate. It may fit their needs a little bit more because we have that ability to use that qualifying income to get them qualified for a house that more likely fits their needs. So that that is a great way to look at these accessory dwelling units as income production and eventually go into their rental portfolio in the future. So again, to take a look at that over 3 years, one additional thing to take a look at is This is a great way to really build additional wealth for somebody. If you were to take that $600 a month and reapply it to put it towards the paying down the principal on that mortgage, after just 3 years, you can see that by applying that extra $600 towards the mortgage, that increases their net worth by over $30,000 in just 3 years from just a traditional increase of net worth from 100,000 to 106,000 to 130,000 just by applying that extra rental income. So lots of ways to help someone build in real estate wealth. So our fourth product is the community portfolio loan. This product I'm super excited about because it's not well known at all. It's something that because we have the bank that is able to lend across the country, we have the ability to do this in many areas of the country that allow us to really focus in on the communities that are able to so we can help those communities that need um, a little extra help to get those first-time home buyers into homes. Now, the growth of the community is important, and that's where we are here to help. The community portfolio loan is a first-time is actually it's not necessarily a first-time home buyer product, but it's structured much like the first-time home buyer products that most people don't qualify for because of income limitations. Meaning most people, in order to buy homes that they can live in, they make too much money to actually be able to buy those homes. But are um, those homes are the homes that are available because we're becoming a non-affordable community. So what this product allows us to do is to um, go into certain areas of our communities and find and focus in on certain areas and offer pricing concessions to make those particular communities more affordable, or the homes in those communities more affordable through lowering interest rates and lowering mortgage insurance costs for properties specifically within those communities. So there's no income limitations for this product. Um, and the only thing that is required is that the property is located within these certain areas. The only way for us to know if the property is located is to make sure it fits on the maps. So those maps we have to search for every property, and I'll give you an idea in a second of where those are, but there are lots of properties available. There's the max loan amount is the conforming loan limit. Max credit score for a first-time home buyer is 640 with minimum of 3% down. A non-first-time home buyer is 5% down at 620, and it is available for 2 to 4 unit properties with 5% down, all the way up to 1.474 million. So there isn't a lot of restrictions other than the property has to be located in these certain communities. So let's take a look at what some of these communities are. So you can see in the Phoenix metro area, you've got areas in Goodyear, you've got areas, there's a pocket in Chandler, there's some in South Phoenix, there are some over within the I-10 202 loop. There are some in El Mirage, up in Glendale, and some in Mesa. So if you want to really kind of take a look to see where they go, you can take a look at them right here. All we do is we kind of go in and try to find where these properties, where these areas are. And you can see here's an area right here. And it really doesn't matter what the price point is. It all that matters is if the property falls in these areas. So in this particular property, it's listed as $475,000 on 16th Avenue, just north of Bell. And there's a couple of different properties in here. There's some other, if we come down here, you can see there's quite a large section over here, but there are many, many properties in these different areas that are available. So the great thing about this is what it really means to a borrower in their monthly payment if you have found a property within these areas. So let me show you that there's a property right here. Lots of great little properties. So if I go back and I take a look at this, let me show you what this really does. So this is a sample property located on 18th Place at 1708 North 18th Place. Maybe it's one of yours. Anyway, this property is located off the 51, just north of McDowell. A 3-bedroom, 2-bath home at $475,000. Super cute. And the numbers for this, making the assumption that someone is renting approximately $3,000 a month, and you've got somebody that, again, at 475,000, if they're looking at this property, most likely they are outside of the income limits, so they're not qualifying for the traditional first-time homebuyer programs that are going to allow them for low down payments or the lower interest rate and lower mortgage insurance costs. So you're looking at just the traditional 3% down because they're a first-time buyer and they're getting traditional interest rates, which have been right around the 7.375 if they don't want to be buying down the interest rates. So at 7.375, you're looking at about $3,827 per month, which includes property taxes, homeowners insurance, and mortgage insurance. And if you take a look at that, that's going to be about $800 a month more than what they're paying for in rent. Now, maybe you can negotiate to get that seller to pay 3% in closing costs. Maybe great negotiation skills. That's going to buy that interest rate down to 6.75%. That's going to drop that total payment down to $3,619 per month. Fantastic. But because we know that that property falls within one of those communities and it would fall, and the borrower could qualify for our community portfolio loan, that exact property, without doing anything different, compared to this product right here, the interest rate automatically drops to 6.5% from 7.375. That's going to drop that property down, that monthly payment down to $3,511 per month. That's not having the seller buy it down. That's not having the buyer buy it down. It's just because it qualifies, because it fits in that community. So if you can get the seller to contribute 3%, you can get that bought down to 5.875%. It's a little bit more than, slightly more than 3%, but you could buy that down to 5.875, and that payment goes down to $3,324 per month. That's a significant savings for somebody just because they knew that property was located in one of those areas. So what does that do? That means that somebody is, again, they're coming in with either 22,000, 23,000, or 16 to $18,000 if they've got the sellers contributing 3%. But that's a $300 a month savings in payment. How are you going to do that otherwise, other than just dropping the price? Or possibly $300 a month is an additional $50,000 in purchase price. They could maybe find a property that is up to $525,000, possibly within those areas, and they could still make that same payment for that $300 a month, but get $50,000 more in house just by knowing about this product. And again, all you're doing is just finding a property located within these designated areas. So this is another great way to get people to know about communities that they are going to get benefits for purchasing within. So again, after just 2 years, is it worthwhile right now rather than waiting? In just 2 years, should they rent or should they buy? Well, after the tax benefit, the net cost is the same, but they will have $73,000 in equity after just 24 months from paying or from buying a property within these communities. So that's a pretty significant amount. I don't think I could save $73,000 myself without the use of appreciation. And I don't think there are many people that could do that as well. So that's a pretty big deal. Now, finally, the best loan, still the best loan out there, is the VA loan. The VA loan is still the top-notch loan for first-time home buyers if someone qualifies for it. 0 down, sellers can pay up to 4% of the sales price in sales concessions. They can do 0 down up to $1.5 million or $1.5 million, credit score of 580 up to $1 million. And then it goes to 620 or 640, depending upon the investor. You have a max debt to income ratio is determined by the automated underwriting system. If your credit score is 620 or more, it's typically capped at about 55% if you have a credit score between 580 and 619. This must be a primary residence for your veteran. Has to be a primary residence, and the veteran has to occupy within 60 days of the note date. So be careful of those lease backs because it is a requirement that the veteran occupy it as their primary residence within 60 days of the note. That's just a requirement of the VA that they sign at closing. Now, funding fees. Funding fees can be expensive, especially if you've used the VA eligibility before. However, what a lot of vets don't realize that if they receive any type of VA disability, it might be $50 a month, $100 a month. They receive any type of VA disability, there is no funding fee charged to the veteran whatsoever. That is a huge, huge savings. That means that they could, I mean, on a $300,000 purchase price, if they've used their VA eligibility before, that's 3.3% that they'll be charged, which is $9,900 every time they've used it on a $300,000 loan amount. If they've received any disability, they don't have to pay that. Almost 10 grand in savings on a $300,000 sales price. That's a big savings. And yet most veterans don't know this. So it's really important for the real estate community to get out and let veterans know what benefits they have. A lot of veterans are not educated in the home loan process. They are not educated on what their eligibility allows them to do. That it's not something that they go around and teach in at the VA. They just don't give a lot of education about it. So this is something that there is a huge need for financial literacy within the veteran community. So um, not only is there an education needed within the veteran community, but there's a lot of education needed within the real estate community about how great the VA loans are. So there's a lot of VA frequently asked questions. Can you have a cosigner on a VA loan? We kind of talked about that earlier. Not for zero down because you have to be a spouse. Um, the other types of, if you do want to do a cosign loan, they're called joint loans, and you can reach out to me and I can tell you how to do them, but you can't do it for a zero down loan. Can you have more than one VA loan at a time? Yes. It's a very complicated calculation, but you can. It all depends upon the amount of eligibility that is left and what the loan amounts are. So before you go out and say, yeah, you can have more than one VA loan, make sure you contact me and I can tell you exactly. We would have to get a copy of the certificate of eligibility and know how much entitlement has been used on the current VA loan. Are VA loans more expensive to the seller? Very, 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 very rarely will the seller pay more in cost for a VA loan than any other loan. Typically, if they are, it's because the lender doesn't know what they're doing. Quite honestly, it's because they didn't disclose correctly. Um, if the lender's disclosing correctly, then there should not be, uh, it's minimal. It's within $100 or a couple $100 that it would cost the seller as long as the lender's disclosing correctly. Are VA loans assumable? Yes, they are, but the entitlement stays with the assumption. So the entitlement stays with the VA loan. So if you have a veteran that is going to have somebody assume their loan, because there's lots of great little 2.75% fixed rate VA loan assumable loans out there, make sure you're warning and letting your veteran know that their entitlement stays with that loan. So they cannot use that entitlement again until that loan is paid off. It also means that their entitlement is tied to that if that person does not pay their bills. So it does have some liability on the veteran that you may want to let them know and make sure that you're not getting them into a situation that they're going to regret and go in blind to. So make sure that you're talking to that veteran about um, all of the ramifications of the VA assumption. And then, can I save money on my funding fee? Yes. If you have used your eligibility before, by putting 5% down, you can drop your funding fee from 3.3% to 1.5%. So definitely worthwhile to look at that if you have some money for down payment. It will save you quite a bit of money. Now, I want to talk about the Certificate of Reasonable Value, the CRV. It's also known as the VA appraisal. That's what the VA calls it. And what is actually known as the Tidewater Initiative. It's what scares everybody. It's what scares the real estate community. And it's actually one of the best reasons why you should love the VA loan, because the Tidewater Initiative describes procedures that for improving communication with VA appraisers prior to finalizing the appraisal report and gives the people involved an opportunity to provide information prior to the completion of the appraisal. So if the appraisal is coming in low, the Tidewater Initiative requires the VA appraiser to notify the lender contact that it's going to come in low. And within 48 hours, the real estate agents that are involved have the option to basically plead their case. They have the option to provide comparables and narratives as to why they feel that the appraisal or that the purchase price is actually justified for that value. So it's what everybody seems to want on other types of loans. The VA is actually giving. The VA provides this extra step as a helpful addition to give that opportunity for real estate agents and buyers and sellers to try to justify the value that they've given in the purchase price to the appraiser before they issue that to the lender for underwriting. So if the appraiser feels that the value may be short, the lender is notified, gives the realtor that 48 hours to provide the additional comparables, and then you can state your case. And it's given back to the appraiser before it's completed. And if they feel justified, they don't have to tell you what they're coming in at before, so they don't really have to justify their position. They'll listen, they'll take it, and they'll decide if your case was made, and then they'll issue the appraisal. So it's actually a positive, not a negative, and I've had more benefit than not negative experiences with that. So it's definitely something that in a market where sellers don't like the VA, it's something to definitely know more about because it really does benefit everybody involved. So definitely things that we should know about with the VA. You definitely want to make sure that you're well educated as we enter into these new markets. So I appreciate you spending the time with me. I appreciate the opportunity to go over all of these products and the ability to help new buyers um, come into the market. And if you enjoyed this information, please like and follow Team Amy's AZ. And if you have any questions, reach out to me, 480-529-3008, or you can email me at aswaney@waterstonemortgage.com. Hope to see you at our next webinar.